The art The artificial intelligence revolution has captivated Wall Street and Main Street, driving trillion-dollar valuations and delivering staggering returns for early investors. Names like NVIDIA, Microsoft, and OpenAI dominate the headlines, and the promise of AI seems limitless. But this explosive growth carries a tremendous financial risk, bringing back uncomfortable memories of the 1990s dot-com crash. Every smart investor is asking, how do I participate in this historic technology boom without losing everything in a bubble? We are going to give you a deep dive into the AI investment landscape. We will analyze the real risks of a valuation bubble, explain the 5 key ways AI generates long-term value, and provide 3 safe, diversified strategies for you to integrate AI into your personal portfolio today. Our goal is to ensure you do not miss out on this generational opportunity, while remaining true to the principles of smart money management. Let us first address the massive elephant in the room. Is the AI market a bubble? The short answer is, portions of it are. A bubble in finance occurs when asset prices become highly inflated, driven purely by speculation and future expectations, not by current revenue or earnings. We see clear signs of this today. Zero-revenue AI startups are raising hundreds of millions of dollars. Valuations for leading AI firms are far outpacing their current profits. This disparity between the promise and the present earnings creates risk, particularly in the most hyped-up segments of the market. However, unlike the dot-com crash of 2000, AI is not simply about connecting people to the internet. It is fundamentally about productivity. It is a utility. This technology delivers real, measurable efficiency gains, which justifies much of the long-term enthusiasm. The key to successful investment is distinguishing the true utility from the speculation. So, how do you find the real, durable, long-term value? We look beyond the surface applications and focus on the 5 layers of AI value generation. This is your blueprint for diversified investment. The silicon layer, the builders. These are the semiconductor companies that design and manufacture the specialized chips, GPUs, and accelerators necessary to train and run massive AI models. This foundational layer is currently the most profitable. The infrastructure layer, the servers and power. These are the companies building and operating the massive data centers, the power grids, and the cooling systems required for cloud computing and AI training. They provide the physical backbone and guaranteed demand. The model layer, the innovators. These are the developers of the foundational large language models, like OpenAI. Investing here is high risk and often requires accessing private equity or venture funds, but the potential upside is huge. The application layer, the users. These are the thousands of smaller companies that are integrating AI models into practical business tools, software, and everyday apps. This is where innovation spreads fastest. The productivity layer, the end users. This is every established, non-tech company that uses AI to cut costs, increase efficiency, or generate new revenue streams. Think of banks, healthcare systems, and manufacturers. Investing in companies that are aggressively adopting AI can be a safer, indirect route to benefiting from the boom. Now that we have established where value truly lies, let us look at 3 actionable strategies to invest safely. Our goal is diversification, low cost, and risk management. Strategy 1. The AI Exchange Traded Fund, or ETF, approach. This is the simplest and safest way for the average investor to gain exposure without having to pick individual stock winners. AI-focused ETFs hold dozens of stocks across all the layers we just discussed. They provide instant diversification across the silicon builders, the infrastructure providers, and the application developers. This strategy protects you from the collapse of any single speculative company, smoothing out the inevitable volatility that comes with a new technology cycle. Look for ETFs with low expense ratios and broad holdings in the technology sector. This approach is your defensive foundation in the AI boom. Strategy 2. The infrastructure proxy investment. Instead of betting directly on a chip designer or a software application, focus on the companies that provide the guaranteed necessities for the entire AI ecosystem. We are talking about the firms building the massive data centers, providing reliable and sustainable energy to power the huge clusters of servers, and offering the necessary cloud services. The demand for these services is predictable and inelastic, meaning companies need them whether the stock market is up or down. These investments often provide solid growth with less extreme volatility than the pure-play application developers. This is an investment in the shovel and the pickaxe, not in the gold miners. These companies are already stable, but their aggressive adoption of AI offers a hidden layer of growth potential without carrying the high-risk valuation of a new tech startup. You are betting on the efficiency of AI, not the hype. Finally, we must talk about the risks and the rules of prudence. The greatest danger in any boom cycle is the psychological tendency known as fear of missing out, or FOMO. This is what drives the speculative bubble. To avoid this pitfall, you must adhere to core principles. Do not over-allocate. Technology is volatile. Limit your dedicated AI exposure to a small, manageable percentage of your total portfolio, perhaps 5% to a maximum of 10%, depending on your risk profile. The bulk of your wealth should remain in diversified assets and bonds. Dollar cost averaging. Do not try to time the market. Instead, commit to investing a fixed dollar amount at regular intervals, regardless of whether the market is up or down. The AI revolution represents an unparalleled opportunity for wealth creation, but participation requires discipline, diversification, and a deep understanding of where the real value is being built. By adopting these strategies, you are ensuring that your money is working intelligently, avoiding the inevitable speculative crashes and setting yourself up for long-term success. If you found this detailed financial analysis helpful and want more strategies to protect and grow your wealth, please leave a like and subscribe to the channel. The goal is always to get you more money. See you next time.